Hello everybody, today's video we're going to go over some security market indices, and for many of you, you're very well aware of a lot of different indices and averages out there that you may follow. Maybe you talk about the Dow Jones Industrial Average or the S&P 500 Composite Index or the TSX Composite Index. We're going to talk about some different varieties of averages and indices in this video today, but really what do we use indices for? Well, lots of different things. We would like to have some sort of benchmark to help us or investors track the performance of different security markets, right? So, whether that's the broad US market or the broad Canadian market, or potentially even specific subsectors within those markets, we would like to know potentially how a sector or an industry or a market in general is doing simply by looking at one simple measure of that. And indices help us do that, okay? And so we have lots of different types of indices out there. Like I mentioned earlier, whether we're looking at the US market, Canadian market, other markets in between, we're going to talk about some of those specific indices here in the next slide. The next point here I have is the basis of new investment products. And this is really starting to be a really big portion of the market, investable market, not only for retail investors, but also institutional investors. And a lot of these basis of indices are for ETFs, right? ETFs, remember, the ETF is really simply trying to track some sort of security market. And how do they track that security market? They're usually trying to track an index or an indice. So at that point in time, we have a lot of big players out there that are creating these indices, right? Talk about S&P or Standard and Poor's, they're really starting to create a lot of these indices. And with that, these investment managers are trying to track some of those indices. And so it's really the basis of a lot of new products that we see coming to the market in today's day and age in 2017 and in the recent past. The next point here I have is to evaluate the performance of managers. Well, again, we can evaluate the performance of ETF managers in terms of potentially, tracking error, right? How well do they track? So that would be, focusing on a passive investment vehicle. How well are they tracking this index or this market that they're trying to mimic? But also, for active style investors or portfolio managers, we need to have some sort of benchmark, all right? And, the index or potentially multiple indices will give us some sort of benchmark that we can compare how well the portfolio manager has been able to do compared to the general market or the average market. So this is a very important component here, is being able to set a benchmark for the investment manager, then for us to compare that and say, well, how well did he do over and above what the general market for the investment style you have done. So these three guys here are three very important components of why security market indices are very important. And there's obviously other points within there, but those three guys are very important to have in the back of your head. Now, there's various different types of indices or indexes out there. And so the first 2 points I have on this slide here, you can see that we're going to go into, a price return index and a total return index. And here, the biggest difference between these two guys here is that a price return index only reflects the price of its securities within the index itself, which means that if we have securities within this price return index that may pay dividends, may pay some sort of interest out of there, whatever it is, it's not, those dividends and interest payments are not going to be reflected into the price return index. As opposed to a total return index, the total return reflects not only the prices, but also the reinvestment of all the income received since the inception of that index. So whether we have dividends or interest payments, these are all going to be reflected back into the total return index. So we can think that, at the inception, right, at the beginning of both of these guys, right, if we had a total return index and a price return index, at the beginning, at the initial stage at T0, these two are going to be what? The same. They're going to have the same exact number. But as time goes on and potentially firms or companies within the index start to pay dividends or interest payments, all of a sudden the total return index is going to be much higher than the price return index. So simply, I'll just show you a quick formula of how we would calculate a simple price return index. This would be the value of the price return index would equal to some summation of all the constituents within the index. Okay, so we're going to take each asset, and then we're going to divide this by some divisor here. Okay, so the D is the divisor, and so if we do that, we're going to really weight the number of units for each constituent security, and we're going to times this by the price there. We're going to have some sort of divisor there. So that's really how we would reflect what a price return index would be. Now, on a total return index, we would have to add in the additional reinvestment of income within there, and we'd have to change this formula a little bit. But we're just going to focus today simply on the price return index, and this would be the formula that we would use. Okay, so let's go to the next slide. We're going to look at some other basics of security market indices. So in the next slide here, we have a couple different types of security market indices. Okay, so here we have, 4 different guys. We have the first one is price weighted index. The second one is an equally weighted index. The third one is a market cap weighted index. And the fourth one we have here are fundamentally weighted indices. So when we look at these guys, they all have, various different, components that we should talk about. Price weighted index, very simple. We're simply going to take each security within the index, and the weighting we're going to use for that security in the index is simply going to be based on its price. So if we wrote the formula down here to take what the weighting of this would be the weighting of asset I in the price index would be equal to the price of asset I, okay, over the summation of all the prices of all the assets that would be in the index. Okay, so that's kind of how that would work. Now, again, here it's very simple, right? So it's very simple. An example of this type of market index would be the Dow Jones Industrial Average. Now, there's some specifics here that may throw off the price index. One thing to remember is that from here, assets or securities within here, assets with high prices are going to be overweighted, right, in this type of index. Okay, so within potentially the Dow Jones, if I have an asset with a price of $1,000 a share compared to an asset that has a price of only $10 per share, well, obviously we can see from this formula here that the asset with $1,000 price is going to be much more highly weighted, and that could skew the index, right, that we have towards higher price assets. So that's one key thing to remember about price weighted. The other thing to remember is that stock splits or adjustments in the type of or the number of assets each individual holds, whether that's a stock split or a consolidation, we have to adjust the divisor. Okay, and there's a formula that we can follow for the divisor. We won't do it in this video. We might follow up with a second video, but that's a key thing to remember. The next one here is equally weighted. Okay, so we can think about equally weighted. It's fairly straightforward. Let's look at the formula. This would be the weighting for each asset in an equally weighted type. We would just take 1 over n, right? So simply each asset in an equally weighted market index would simply be somewhat proportional to the number of other assets within there, right? They would be equally weighted. It's simple. We don't see a whole lot of equally weighted types of indices. One very popular type indices is the S&P 500 EWI, and EWI stands for equally weighted index. Okay, so if you wanted to look at how an equally weighted versus a market cap weighted or a price cap weighted, you could potentially compare some of these, and we'll look at the next one here, and this is going to be a market cap weighted, which is the most popular here. And simply for this, we would look at the weight. So we'll draw the formula here. The weight of each asset in a market cap weighted would equal to Q times PI, right? So each individual security over the summation of all these guys together. Okay, so QJ, PJ. Okay, so here, larger firms. Okay, so larger firms that have a higher market cap, okay, together are going to give more weight to the actual index itself. So if we put larger firms, will give more weighting, right? Will lead to more weight in the actual index, okay, or in the indices. So these are very popular, these market cap weighted indices. And so, some examples of these would be like the DAX in Germany, we have the CAC in France, we have the S&P 500 in the US. These are market cap weighted. And what this does is that it does weight a little bit more to large cap. And so the issues here are you're sometimes left holding the firms that may have had a run up in price that may be actually overvalued. Okay, so firms that have had a potential run up in price that may be overvalued at this point in time, they're going to end up being larger based on their market cap. Okay, and hence they're going to have more weight in the index themselves, which may lead you to underperformance in the long run. And so, there's lots of different examples of, this types of firms that have run up to be very large market cap and then have dramatically reduced in the price. A key example in Canada was Nortel, right? Nortel Securities, or Securities Nortel Networks. At one point in time, I believe they had approximately 35% weighting in the TSX 60 index, right? And if you're in Canada and you've heard of Nortel, if you had a 35% weighting in Nortel on your portfolio at some point in time in the early 2000s, it was probably not a good performance for you going forward. But that's just an example of potentially overvalued securities in a market cap weighted. And we have to be careful here because remember, a lot of ETFs will track, right? Will track these types. So that's why it's important to understand the indexes, especially in the investment age we live in today. The last one we'll talk about is fundamentally weighted. Okay, so fundamentally weighted, they try to get away from, potentially holding these overvalued firms here. We just talked in market cap. Here they're going to use a measure of the company's size that's independent of its security price. Because remember, the market cap over here that we just calculated is simply, it's going to be the number of shares that the company has times the market price of each of those shares. So here, the price of the security is obviously going to have a big impact on, how much it's going to be counted towards the actual market capitalization and the weighting that it has. So here in the fundamentally weighted, we're going to try to disengage this of its security price, and we're going to try to use weightings that are based on other types like book value, cash flow, earnings, different types that may limit the inclusion of overvalued firms within the actual index itself. So a lot of times we see this sometimes if we do this leads towards some sort of value tilt sometimes that we call. And that can be very good for you. And in another video, or I think I already have a video in Excel that shows you potentially the value tilt. And we look at the Fama French, 3-factor model, and we add the Carhart 4-factor on there. Sometimes having a value tilt is a very good thing. Okay, so that's the video from security market indices. We'll follow up with another one shortly.